Welcome back to Dinar Community Channel. The world of international finance is often defined by quiet negotiations, subtle market movements, and decisions made in hushed boardrooms. Yet every so often, an event unfolds that shatters the silence and ripples across the globe with the force of an earthquake. The revaluation of the Iraqi dinar became precisely such a moment, igniting a chain reaction that would soon be known as the cash-in crisis. What began as long-awaited relief for investors and citizens alike transformed almost overnight into a storm of chaos, overwhelming systems, collapsing infrastructure under its own weight, and forcing governments, banks, and individuals to scramble in ways they had never prepared for. For years, speculation swirled around the potential revaluation of the Iraqi dinar. Some dismissed it as fantasy, while others held fast to the belief that one day Iraq would reclaim its financial standing and the currency would soar to levels not seen since before decades of war and sanctions. That belief was fueled by Iraq's vast natural resources, its untapped oil reserves, its rebuilding economy, and the whispers from international institutions hinting at an eventual restructuring. Investors, both small and large, clung to their bundles of dinar, seeing them as tickets to future wealth. For ordinary Iraqis, the dream of revaluation was not just about profits but about national pride, stability, and the restoration of purchasing power that had long been denied. When the announcement finally came, it was both celebrated and feared. On paper, the Iraqi dinar had been reset to a value far stronger than anyone had dared to predict. Overnight, stacks of notes once dismissed as little more than souvenirs suddenly represented life-changing fortunes. At first, it felt like a collective victory, the vindication of years of patience. Crowds gathered outside banks in Baghdad, Basra, Mosul, and beyond, eager to exchange their old holdings for the new reality. But what followed was not the smooth transition officials had promised. It was an eruption that revealed how unprepared global financial systems were for the tidal wave of demand that crashed against them. Exchange centers around the world became the front lines of this transformation. In major cities across the United States, Europe, and the Middle East, lines stretched for blocks. Banks opened their doors to a flood of people desperate to lock in the new rates before anything changed. In many cases, systems designed to handle routine volumes of transactions collapsed under the unprecedented strain. Software crashed, ATMs malfunctioned, online banking portals froze, and tellers found themselves writing out manual records as digital systems buckled. The promise of smooth liquidity was buried under the weight of reality. Transactions that should have taken minutes dragged into hours, and then into days. The crisis escalated when the surge spread beyond Iraq's borders. In places where dinar had been quietly held for years, by veterans, expatriates, hedge funds, and speculative investors, the sudden spike in value prompted a mad dash to cash in. Entire networks of exchange centers were swarmed. Families arrived carrying envelopes, briefcases, even suitcases filled with currency. The scenes bore a striking resemblance to old bank runs, where panic and urgency fed into one another, amplifying the pressure on already fragile systems. Each new wave of customers further strained the infrastructure, turning what should have been an orderly process into something closer to a financial free-for-all. Government officials tried to reassure the public, insisting that the revaluation was under control and that mechanisms were in place to process the demand. Yet the reality on the ground told another story. In smaller banks, employees worked around the clock, sleeping on cots in back offices. In larger institutions, IT teams fought to restore systems knocked offline by the deluge of transactions. Call centers were swamped by customers demanding updates, while social media became flooded with images of long lines and frustrated voices warning others of delays. Every promise of a fix was met with new cracks in the system. The cash-in crisis had spiraled far beyond what planners had anticipated. What made the overload particularly dangerous was the interconnected nature of modern finance. The Iraqi dinar revaluation was not an isolated event. It was tied to global networks of liquidity, foreign exchange markets, and international settlements. As millions tried to convert their dinar into dollars, euros, or other stable currencies, central banks were forced to intervene to prevent imbalances. Currency traders saw wild swings in related markets, with ripple effects hitting oil prices, bond yields, and even equities. Investors who had never paid attention to Iraq suddenly found their portfolios exposed to volatility. The world realized that one country's currency shift could send tremors through the very core of international finance. Amid the chaos, stories emerged that captured the human side of the crisis. Some were tales of sudden fortune. A retired soldier who had held onto dinars since his deployment, now able to pay off his mortgage and fund his children's education. A widow in Baghdad who exchanged her savings and finally felt the security she had long been denied. But there were also stories of heartbreak and frustration. Families who arrived at banks only to be turned away when systems went down, investors whose transactions froze halfway through, leaving them in limbo, unsure if their holdings had been credited or lost. In some cases, scammers preyed on the desperation, offering quick exchanges at special rates, only to vanish with people's life savings. The overload of systems was not just a technical failure, it became a social and political flashpoint. Protests erupted outside banks in Iraq, with citizens demanding transparency and accountability. In other countries, regulators faced tough questions about why they had not prepared for the wave of cash-ins. Politicians scrambled to offer reassurances, but trust in institutions was shaken. Some critics argued that the revaluation had been rushed, a political move meant to showcase Iraq's resurgence without fully accounting for the logistical consequences. Others countered that no amount of preparation could have truly braced the world for an event of such magnitude. In the background, financial institutions began quietly adapting. Some banks instituted appointment-only cash-ins, forcing holders to schedule times rather than flood branches. Others capped daily limits, creating longer timelines for redemptions but giving systems breathing room. International clearinghouses revised protocols to smooth settlement flows, while central banks injected liquidity into markets to stabilize currency pairs. Slowly, painfully, a degree of order began to return. Yet the scars of the cash-in crisis lingered, and the memory of overloaded systems became a case study in how fragile the global financial web truly was. As the weeks dragged on, economists began analyzing the deeper implications of the dinar's revaluation. The sudden infusion of wealth into millions of households promised to transform not just personal finances but entire economies. Real estate markets braced for surges in demand as newly enriched investors sought to park their money. Luxury industries prepared for booms, while wealth managers opened their doors to clients who only weeks earlier had been dismissed as speculative dreamers. At the same time, concerns grew about inflationary pressures, tax implications, and the potential for reckless spending sprees that could destabilize local economies. The challenge was not just processing the cash in, it was managing its aftermath. The overload also sparked debates about technology and resilience. Why had banking systems, in an era of digital innovation, been unable to handle the surge? Experts pointed to outdated infrastructure, underinvestment in capacity, and the assumption that such an event was too unlikely to justify preparation. The cash-in crisis became a wake-up call, urging governments and banks to rethink how they built systems for the future. If one revaluation could bring global networks to their knees, what would happen in a true multi-currency reset or a digital shift involving trillions? Within Iraq, the revaluation remained both a triumph and a challenge. For the government, it was proof that the country was no longer shackled by its past. The dinar had become a symbol of national pride, a declaration that Iraq could once again stand shoulder to shoulder with economic powers. Yet the logistical failures threatened to overshadow the symbolism. Restoring trust required transparency, investment in banking infrastructure, and careful communication with citizens. For Iraqis who had endured years of hardship, the revaluation was not just about numbers on a screen, it was about dignity, security, and the belief that a brighter future was possible. On the global stage, the cash-in crisis added fuel to discussions about the future of money itself. As governments experimented with central bank digital currencies and blockchain-based systems, many pointed to the dinar event as evidence of why modernization was urgent. If distributed ledgers or digital platforms had been in place, perhaps the overload could have been avoided. Others cautioned that no technology could fully eliminate the human factors, panic, speculation, greed, and desperation, that magnify crises. The revaluation revealed that money is not just a technical construct but a deeply human one, carrying with it the weight of hopes, fears, and ambitions. The narrative of the cash-in crisis continues to evolve. Some now describe it as a necessary growing pain, a difficult but unavoidable step in Iraq's return to the global financial stage. Others see it as a warning, a reminder of how quickly systems can fracture under pressure. For those who lived through it, whether waiting in endless lines, watching transactions fail, or suddenly holding wealth they never thought possible, the experience is etched in memory. It was a moment when the promise of prosperity collided with the limits of preparation, when the dream of revaluation became entangled with the reality of overload. The lessons of the crisis stretch beyond Iraq, beyond currency speculation, and into the very fabric of global economics. They remind us that wealth, when unlocked suddenly and en masse, can overwhelm even the most advanced systems. They highlight the importance of resilience, foresight, and coordination in a world where finance is deeply interconnected. Most of all, they reveal that behind every currency are millions of lives shaped by its value, lives that can be uplifted or disrupted in a single sweeping change. The cash and crisis is far from forgotten. In every country where the dinar was exchanged, in every household where sudden fortune arrived, in every institution that struggled to cope, the memory remains. It stands as a testament to the power of financial transformation and the fragility of the systems that support it. And while the revaluation of the Iraqi dinar may one day be remembered as a turning point in the nation's history, it will also forever be linked to the moment when the promise of wealth collided with the hard reality of systems pushed beyond their limits. Like and subscribe for more videos.